Imagine a jar slowly filling with money day after day, a symbol of disciplined saving and hope for growth. But one day a hole forms at the bottom. Subtle at first, it quietly drains the contents until the jar is nearly empty. That invisible leak is inflation, stealing value silently, steadily, and faster than most financial rules ever admit. Compound interest, once seen as the savior of savings, no longer holds the power to stop the bleeding. The math doesn't lie, and optimism won't change its outcome. For decades, people were told that wealth grows with patience. Set aside a small amount, wait long enough, and one day retire with comfort. That idea worked when prices rose gently. But today, prices sprint. A savings account growing at 5% while living costs increase at 6% means losing ground every single year. The balance may rise, but the buying power falls. This is the fatal flaw of traditional compounding in a high inflation world. Consider Veronica, a 30-year-old who sets aside $200 every month into a safe fund earning 5%. After 20 years, her statement proudly shows $81,000. Yet in that same time, prices have doubled. In real terms, she holds only $40,000. 2 decades of discipline bought her half the life she expected. She followed the rules, but the rules are broken. The economic climate has changed. Governments printed trillions. Supply chains broke. Energy costs surged. Wages chased prices, and prices chased wages. In just 5 years, over 40% more currency flooded the economy without a matching rise in goods. More dollars, same goods, inevitably, prices soared. This wasn't a temporary flare-up. It's structural, policy-driven heat. A car once worth $25,000 now sells for $33,000. Average rent now consumes half of income instead of one-third. Grocery bags feel lighter even as they cost more. Every price hike erodes the real value of static savings. Even chasing higher returns isn't enough. Markets that average 8% gains can be wiped clean by a single year of 10% inflation. That's because real growth equals nominal growth minus inflation. If inflation wins more years than it loses, even the most patient investor loses in the end. High earners aren't spared either. A surgeon parking cash in 3% bonds loses 3% of purchasing power annually when inflation sits at 6%. A slow leak that adds up to thousands vanishing quietly. Traditional compounding was designed for a world that no longer exists. Adding small amounts over time or waiting longer simply won't close the gap. What's needed is a new lever, one that doesn't resist inflation, but rides with it. The key lies in owning assets whose cash flows rise with inflation, then reinvesting those flows into more of the same. That's dynamic compounding. That's turning the down escalator into an up escalator. Real estate with flexible rents tells the story. A $100,000 property yielding 5% now could pay 6%, 6.5%, or more over time if rents rise with inflation. Reinvesting that growing income accelerates the path to a second property, then a third. Each one adds more rising income. Each one feeds the loop. The snowball grows faster than inflation can melt it. Public companies with pricing power follow the same logic. Essential software providers, for example, can raise fees annually. Dividends increase. Reinvested dividends buy more shares, more income, more protection. This principle applies across asset classes, royalty streams linked to sales, energy investments tied to oil prices, farmland yielding rising crop revenue. Even a person's skills can become a floating asset. A graphic designer who learns 3D animation may double their income in a year. If rates rise with prices, income stays ahead and becomes fuel for more investment. The pattern is simple. Rising cash flow buys more rising cash flow. A vending machine owner starts with 2 units making $100 a month. As snack prices climb, so do retail prices. Margins stay intact. Profits grow. After 5 years, 10 machines generate $1,200 monthly in today's dollars, even as prices double. She beat inflation by scaling income that floats. The danger lies in relying on fixed yields, flat bonds, static salaries, predictable coupons. These are financial traps that erode quietly. The only true defense is to own income that adjusts, reinvest it relentlessly, and scale up. This is how compounding becomes alive again, how the old jar stops leaking and starts expanding. Inflation doesn't sleep, so strategies must evolve. Every time a price rises, it should signal a raise, not a loss. With the right assets, that's exactly what happens. Each hike sends a wave of cash flow upward. Each reinvestment builds a faster engine. The spiral reverses, and the whole becomes a ladder. This is not just theory, it's the only way to win in a world where inflation leads the dance. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.